Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to be joined by Adi Imsirovic. He's a senior research fellow at the Oxford Institute for Energy Studies. He was also the previous head of oil trading at Gazprom Marketing and Trading and director, a regional manager of Patraco in Singapore. All of this background, all of this deep experience that Adi has resulted and been poured into his latest book, Trading and Price Discovery for Crude Oils. Welcome, Adi.
Hi, Sean. I'm in rainy London. Glad to be on your webcast. Thank you very much for having me.
Adi, it's an absolute pleasure to have you, and even more pleasure to have the chance to read your book. It's surprising in so many ways that a sector, oil markets, trading, massive multi-billion-dollar industry, and yet very little written about this space with any deep insight. Your book, your experience as well, one of the first occasions we've seen some journalists write books here and there, but from the inside, having done it, bought the t-shirt, so to speak, and you put that down on the page. What was your driving sort of motivation to bring a book of this nature to the market?
Well, it came from several sources. I mean, I also, on top of my 30 plus years of trading in the industry, I also spent at least 5 years of teaching at the University of Energy Economics. So it all came together. The idea for the book came a while back in summer 19 or spring 19, when I was asked to write a chapter for a book by Palgrave it's a handbook on energy economics. It's about trading and oil markets, very simple. And then I realized that it's virtually impossible, as you, Sean, would know very well. It's very hard to explain something like a Brent market without going back to history. So essentially, then I wrote that chapter with a backdrop of a narrative, a historical narrative, and then we decided to expand it into a book. Now, I wouldn't have written a book if I didn't have, a few other things to say, of course, and implicit in the book are at least a couple of hypotheses. Basically, it's well known that the structure of the market affects prices, but also the process of actual price formation, how the prices are set, reflects the market structure, and the actors and the type of actors in the market also reflect the market structure. So it's all tied to the actual price. More importantly, for people in the industry, we see more and more players in the market, such as exchange traded funds, ETFs, various funds. They're coming in, putting big bucks in the market, and actually with very little understanding how the market is working. And
we saw that classically last year, didn't we, with some big train crashes?
Absolutely, and I actually spent some time talking about that WTI going well negative and explaining what happened as much as I can, obviously with the lack of data. So the book essentially is in two parts, is essentially explaining the working of the oil markets with the backdrop of historical setting and why certain things are the way they are. Because, like if you didn't know how, if you come to the Brent market from scratch, you would think it's really, really odd. And the reason it's odd, like many things here in Europe, is the history behind it.
Well, if you take just on the bigger picture of as I said in my introduction, how rare books of this nature are, these sort of deep insights into the trading sector, is because for so long this has been a space that has been really a closed door. I mean, it's a cloistered sort of windows shut, say nothing to nobody. Energy trading companies are sort of classic for their sort of mercurial nature and so forth. Are we seeing that change, the markets change from fundamentally one in which was kind of in that shut down posture to one that now is opening up?
I think we are, Sean. I think it's been happening for a good decade, I think. And the reason for that is that the markets are so dynamic and changing so much that actually you're not giving away any sort of family jewels, no secrets. if you were trading like Mark Rich in the sort of late 70s, in mid late 70s, of course you had your secrets and contacts and personal relations are aside, there always will be sort of very important in oil trading. But the market is changing so fast that you basically, you're not actually giving away much by explaining how things work, because the idea is that we could only help the market to become better and more transparent, and that's one of the goals of my book.
When we consider from this what's at stake point of view for a non-trading audience to really understand what is every day at stake when oil markets are operating, just give us a sense of scale of what we're talking about from the point of view of volumes every day. We have a physical market, we have a paper market. How big and how relevant are they to the average person?
Well, everything that we touch is actually, in terms of economic system, is driven by oil price. When you wake up, if you're in finance in any shape or form, the first thing in the morning you check where the share prices are, but you also check where the price of oil is just as well. You check other economic indicators. So it's a key economic indicator. So understanding how that price is set is absolutely crucial and essential. We're trading at the moment, well, let's call it 95 million barrels a day of oil, physical oil, but paper oil is a very large multiple of that. And it's actually even hard to tell what multiple it is, because a lot of derivatives traded in oil are in unregulated markets, even though after the sort of financial crash of sort of 2007-8, we have a lot of a big move towards the exchanges. But I would say in the Brent market, at least 10 times as much derivatives is traded as there is of physical oil. So, you multiply, let's say, 100 million barrels a day times 10 times, price of oil of $75. These are the amounts that we're talking on a daily basis. It's staggering.
When we look at the major contracts and just coming out of this COVID year, we've seen a few things emerge structurally that have been unprecedented. Obviously, you mentioned WTI, which is the US benchmark, going into negative territory. We also saw during the year moves to Brent, to expand Brent to include WTI again, and we also saw the launch of the Murban contract in Abu Dhabi. I wonder if you just talk us through some of these developments. Is it a coincidence that they all happened this year? Is there something significant shifting in the market that is putting a bit of some earthquake under these major contracts?
Well, Sean, there are two things happening. The one is a more longer term trend that's been going on since the late 90s, is the shifts in the oil flows. Whenever the oil flows change, you have a change in benchmarks. It's inevitable. So the center of gravity of the oil trading has moved from the Atlantic basin to Asia, east of Suez. So that's number one thing. Number two has been the advent of shale. So you have a freely traded crude oil with very acceptable quality being accepted in Europe, becoming almost a base rate in Europe, but also base rate in Asia and elsewhere, South America even, and elsewhere. So you have this big shift in sort of movement of oil. So naturally leading to need to adjust your benchmark. So if you're sitting in Europe, you're a refiner, and if a big chunk of your base rate in your refinery is now WTI, how relevant Brent becomes. You're asking yourself a question, because if you are looking for an alternative to WTI, which is your base rate, then you will ask natural question, so where is that price versus WTI, not versus Brent? So the whole relevance of Brent becomes questionable. So that's the main reason why I think the
WTI now US exports are up to 3 to 4 million barrels a day.
Absolutely, and you can have Europe receiving a good million barrels a day on regular basis, both in the north and the south. So it's become sort of a base rate for many European refineries. So the relevance of certain benchmark is changing. So that's why we have these big changes. The other reason is that we have, since roughly, in the last few years, we have had a buyer's market, not necessarily right now as we speak in the current market with OPEC Plus and so on, but on a long-term trend, we've had a buyer's market where essentially to be competitive meant being more related to the market. Let's not forget that the reason we have benchmarks right now, and that's one of the things the book is addressing, is this historical perspective where roughly in mid-80s, it was Saudi Aramco that basically went to their partners and said, look, lift the oil, please. And they said no, because the market price, spot price, is well below your official prices. So they essentially said, well, at what price would you lift it? And that's how the whole system emerged. It was the meeting of the Aramco partners in Aramco, where basically it was agreed that the prices for the United States would be linked to, surprise, surprise, ANS, to Europe, to Brent, and to Asia, to Dubai later on. Obviously, ANS changed to WTI.
So well, if you look at that argument, that point you make, that WTI, which for most of its life has been an inbound oil price, because only WTI could only be sold in America. Now it's going global, and so it's, as a reference price, becoming much more central. And then the flip side of that, the existing global benchmark is Brent. And over the last year, we also saw some attempts to make, and we've seen in recent years, adjustments to Brent, because obviously Brent as a crude in the North Sea is diminishing. And so we've added multiple grades of Norwegian oil and et cetera to that basket. Now WTI, is there a long-term fracture there with Brent that it has to continue to adapt, or is that indeed its strength?
Well, I actually think that it's one of its strengths. Analyzing in the second part of the book all the markets, I think that having alternative delivery is actually strength. What alternative delivery first started in the US, actually with WTI. After 86, US is obviously up until 86 was also a very large producer as well throughout history. And the supplies, local supplies into the WTI contract actually dried up. So to actually make, it was totally liquid. So to make the WTI liquid, what at the time NYMEX did was to introduce alternative delivery. So when I worked at Texaco, we delivered Bonnie Light into WTI, Brent was delivered into WTI, and actually liquidity picked up and the contract was livened up and revived, because what alternative delivery does is actually not only increases the volume of oil coming into the contract, but actually brings you all these new other players that probably wouldn't have been in that market at all. So somebody trading West African or Brent suddenly is coming into TI contract and trading it. So I think alternative delivery is actually a strength. And I think that's something that the Middle East benchmarks, starting with DME or Oman and now with MERB, and will probably over time learn and probably
because that's bringing up the point of that contract. I mean, one of the sort of positions of sort of the unique selling proposition of the new Murban contract in Abu Dhabi is the opposite of that. It's a large volume of one singular crude, up to 2 million barrels a day. Brent is obviously, as we just talked, multiple grade basket. How does that have a strength if the Brent, how do you see, because that's also emerged in this window of time. Is it a competitor to all of these other benchmarks? How do you see its place?
Well, Mervyn, in long, you've read the book, I've addressed that, and I've written a lot about Mervyn anyway. I think it has a very good chance. It's a solid contract with good volumes. But going back to the whole idea of a benchmark is a type of crude that people would have trust in to reflect the market value. As simple as that. And now on the back of that statement, you can add, it has to have a liquidity, it has to have a lot of buyers and sellers, liquidity in volumes, a lot of buyers and sellers, no government intervention. It has to have a number of other factors like logistics and so on and so forth thrown into that. Now, Mervyn is, I think people are getting over ambitious with Mervyn too quickly. I'm very positive about Mervyn, but I think what we need to be is make sure that Mervyn proves to be the contract where, for example, the fact that UAE is a part of OPEC is not impacting the contract in terms of, you know, OPEC cuts and so on and so forth. That the fact that the refinery that runs primarily in Murban does not use, that ADNOC does not use their own position as such to impact the market, because you don't want a market where somebody can easily influence the price. So once you get that confidence, sure, it will take off. But at the moment, you know, it will take time. It does take time. So this is what the alternative delivery, in my opinion, does, is that you say, okay, if I can't get Murban because ADNOC is suddenly running more Murban in the refinery, or I can't buy it from them, well, I can just deliver, you know, DAS, or I can probably deliver an alternative 40s into it. I'm obviously, you know, making it up right now, but I have an alternative delivery that can enable me to do that. What it does to a trader, it gives the trader confidence, and they can trade it without being squeezed one way or the other. So I still do think that alternative delivery plays a very, very important role.
Is there a model that is better? I mean, if you take the alternative delivery versus singular source of Murban, is it more accommodating for physical oil traders, or is it more accommodating for paper traders?
Well,
derivatives.
It depends, Sean, what you want your contract to be. I mean, you can have currently DME contract is an excellent exchange for physical oil, but I don't necessarily think that DME exchange wanted to be just a physical. You don't get the multiple of trades if you don't have sort of bigger paper volumes. And bigger paper volumes you tend to get by more players coming in without worrying that they have to deliver a physical cargo or they have to lift it. And they have no choice other than that. I've traded DME since day one. And I remember so many times on the last day of trading, there was a problem. I'm thinking like, I still have to buy my, I don't know, 25 lots, but there's nobody on offer. You know, if I have alternative crude to be delivered, or I can deliver alternative crude, that helps. I wouldn't necessarily put Murban versus Brent. I think alternative delivery is a good idea, but surely it's a good idea to have good volumes as well.
I mean, ultimately, the underpinning strength of everything is liquidity. It overrides geography. You started out your comments saying the big change in the world is the move to the east. Demand center has moved from the west to the east, as it has for pretty much everything, but also for energy and oil. Does that make a difference from the point of view of liquidity of a contract versus the geography? I mean, Brent is an oil basket from the North Sea. Is it relevant to pricing oil east of Suez anymore?
It would be. I think there is a room in the world for a lot more benchmarks. There's no doubt about that. That what makes Brent very, very special is the institutional framework that you have in the UK. And that goes back to I have a whole chapter on liberalization in 1980s. Let's say British law is accepted everywhere. And even now, if you trade most grades around the globe, you would probably use English law. So that institutional framework, the legal system, which is very friendly towards trading, the government that's very friendly towards people coming in and trading, Singapore being a great example, Dubai, Abu Dhabi being good examples, and so on. That whole institutional framework is what makes a certain benchmark. The fact that, let's say, Murban or INE Shanghai contract reflect the regional market a lot better than Brent is not as important as liquidity. Liquidity always trumps the basis risk. Very good example is Dubai, Oman. Most Asian refiners have exposure to both Dubai and Oman, but very often most of them don't use Oman to hedge their exposure at all, because there's more liquidity in Dubai. They trust that market, they can get a lot more volumes done. So they just ignore it because liquidity trumps always the basis risk.
Let's just talk a little bit about China. Obviously, the huge demand center in Asia, and also in this recent time, although it was before the COVID traumas, it launched its own contract, but it has recently started to do some structural changes to the Chinese oil market in terms of quota management and so forth. What's your outlook for the Shanghai contract and the China market?
Well, Shanghai contract is very important. All these contracts that actually succeed, and it has succeeded in terms of volume, it's now the third biggest oil exchange in the world, are very important because they add to price discovery. Is it a regional benchmark? No, it's not even a regional benchmark. Will it be a global benchmark? No, let's not even talk about it, because the key reason, and this is what I spend a lot of time in that chapter in the book, is you can't have a benchmark, a properly freely functioning market and a benchmark without liberalization policies. China is slowly going that way. They are slowly going that way. But if you don't have liberalization, if you're worried that if you're trading a contract, but you're not quite sure how you're going to get money out of the country that you made, it's a problem. If you're not sure that you put something in the bonded storage and there are only maybe 2 buyers out there because of certain pipeline links, you're worried as a seller. We've seen in the last year or so quite a few cargoes actually being loaded from the bonded storage in China being shipped to Korea. Now that's not very good. Why should somebody double freight? Doesn't make any economic sense. Well, I think obviously, unless you have all the data and prices, which I don't, and nobody does, I think, except the people who are involved. The main reason is that quite often, and I've been in that situation several years ago, you put something in storage in China, and you have 1 buyer or 2 buyers. And you're squeezed on price. So sometimes it's cheaper and you want to make a point of taking it back to Korea than sell it. So these are all institutional framework, the setup of the contract. There's so many variables to making a particular contract succeed. And INE has succeeded, and they've done a great job by in April last year, April, May, June last year, by increasing the volume of storage very, very quickly. They doubled the volume of storage that was becoming a problem. So they have a lot of things that react.
And storage as a whole in China has grown dramatically through the COVID year, from about 90 days cover to 100 days.
Yes, I mean, they're a very price sensitive buyer, very much like India when it comes to LNG and other products. They are very price sensitive buyers. So, INE contract is doing very, very well. Will it become a major regional benchmark? I doubt it in the short run.
I mean, you did say there that it's good to have more benchmarks. There's a certain view. There's a certain view that says actually the opposite of that. That there isn't space for all of these contracts. There isn't demand. They don't all fill a unique problem that they're solving. What are your thoughts on that?
Well, I've got very clear thoughts on that. It usually comes from PRAs and other exchanges that are worried about losing the volume. But actually, I remember over a decade ago talking to DME guys about their contract. It did not in any way impact Dubai. If anything, actually, it sort of increased the volume because people start then arbitraging. So when Brent contract started in 1988, it didn't hurt WTI at all. It actually, the arbitrage between Brent and TI just increased. So most of these contracts actually just offer more opportunities. Merben contract, I think I was the only one to bring this point up because I've been quite involved in sort of LNG as well on the sort of hedging side of things. A lot of LNG is still pricing on JCC bases. Not many people understand that actually Merben is a really good instrument to use to reflect because it's a big part of the JCC basket. Voila, great. You've got a contract that now gives you something that other contracts did not. And that's why I always say, well, let's not get too carried away with Merben replacing Brent. Give it some time, make sure it works, but it adds value. And over time, all these benchmarks evolve. Benchmarks are not made up overnight. They tend to evolve.
And they also, as you said earlier, attract a lot of derivatives traders, paper traders that, like any other investable asset, if you look over the 30 years of these benchmarks, has attracted huge money into a sector that previously didn't exist.
Absolutely. And to do that, to make the contract really liquid, you really have to make sure that those people, and a lot of these people, let's not forget, Sean, I mean, we talk about oil every day, and you particularly there all the time. A lot of these guys investing into ETFs, investing funds, they really know very little about many of these contracts. So you have to have that confidence that when you buy or sell, and this is why Brent is Brent. When you buy or sell something in the Brent market, you are sure you will get out of that position. So you have to be, so to make a contract, A, super successful, B, to make it a benchmark, you have to have a contract that you really don't have to worry about your last day of trading, whether you're going to get a physical cargo or not. Nothing against physical deliveries. There's nothing wrong with those contracts. You just have to have a contract that's liquid enough, or if there's a cash settlement, that you actually do settle cash at the appropriate price, market price.
I can't let you go, Adi, without talking sort of news of the week. OPEC Plus have their next meeting on July 1st. They're coming to a big decision about adjusting supply for the rest of the year. What is your expectation? What do you think they should be thinking?
I think OPEC should increase their supply. I think there's a great concern right now about availability of oil. I think the market is very, very strong. It has been very strong for a while. We've been drawing stocks. I personally think that it would be better for Saudis to supply more oil than to see cheating creeping into the alliance. I think that would be more detrimental. At these levels, I think there's a high temptation for everyone, including non-OPEC members and non-alliance members, to come in and supply. So I think letting some extra oil into the market and sort of keeping their customers happy would probably be the right approach. Having said that, it's not easy, Sean, because we again, in the UK, we're getting a third wave of COVID again. It's just this COVID's been so hard and so unpredictable. Again, I think OPEC Plus, particularly led by Saudis, the idea of having these monthly meetings, the idea of having that 1 million leeway that Saudis do have, give them a lot of room to play with.
But what about that point that, I mean, the last occasion they adjusted supply, they gave us a 3-month light sign of, outlook on that. Do you think they should be thinking similarly, not just month to month, but give it sort of a 3-month vision, or what are your thoughts on that?
I think this time will be harder to do that. I think we saw kind of the end of the COVID wave when they came with that 3 months. It was a good idea at the time. Personally, if I was them or if I was advising them, I'd say no. I think that they have enough leeway with that Saudi million to supply extra if it's needed in the market. So I think the market will retain control of the market. I don't see the spikes that Goldman see to 100, whatever, 80 plus 100, unless there's some geopolitical issue. And I think there's still a huge amount of uncertainty. We're still in that sort of demand shock mode.
But you are seeing inventories decline now below 5-year averages and could decline rapidly over the second half of the year if we didn't get a serious supply increase.
Well, exactly. That's why I'm saying.
Is that a good thing or a bad thing, do you think?
Well, it depends whose point of view you're looking at. If you're a
Exactly.
consumer, it's a very bad thing. And I think oil prices could spike quite significantly. I think they could. We could see spikes over $80 quite easily. I think that's exactly why I think the Saudis and the others, I mean, Saudis are clear a leader, should supply more oil to the market. But again, they have to be very careful, because if you look at Australia has now a COVID problem again, very little vaccination over there. And, the whole of Asia is still not out of the woods. Nor are we.
Well, we need to leave it there, I'm afraid. Thank you so much, Adi Imsirovic, author of the great new book, Trading and Price Discovery for Crude Oils. A very easy read for your non-technical markets person, and very informative. And as Adi said at the beginning, and I would concur, knowledge of the oil markets is relevant to so many sectors, and even to the average person, but ultimately multiple sectors of professionals in the finance industry. A great read, and congratulations, Adi, and thank you for being on Halftime Talk this week.
Thank you very much. It's been a pleasure, Sean. Thank you.